Hello and welcome to Portfolio Matters Week 29 weekly update. And it has been a volatile and unpleasant week in the markets. And before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Okay, before we get into it, some news about Portfolio Matters in that we have hit 1,000 subscribers. Hurrah! And that means that we can accept advertising on YouTube. But the good news for everyone is that I find those adverts incredibly intrusive and annoying, and I have no intention of accepting them. However, we would like to find a sponsor because we would like actually to outsource some of the research, which we are finding it difficult to find time to do, to a nice Indian chap or something, so we can cover more companies. So if we could find a sponsor, we could pay for this. Now, when it comes to sponsorship, we do have some ethical standards. So porn, weapons of mass destruction, etc., those are all acceptable. What is not acceptable is the sort of dodgy financial products you get pushed on YouTube. So if you want to sell sarin gas, that's fine by us. If you want to sell dodgy financial products which are guaranteed to lose our viewers' money, then go away.
Keith, anyway. I think if we're going to carry adverts for things like sarin gas, we need to amend the disclaimer slightly.
Yes. Anyway, let's get on with it. So this week, well, the ECB met and they basically said that they were happy with the way things were going. They're going to continue with negative rates. In fact, the outlook was for more rather than less QE going forwards. So going through the economic data we got this week. So last Friday, we got EU inflation numbers, and EU inflation came in at 1.9% in June, which was slightly down from May, but hit expectations. Bear in mind that the EU has struggled to hit its 2% target for many years, and it looks like the inflation pulse may be fading again. So the core inflation came in at 0.9% compared to 1% in May, and that is well below target. Moving on to the US. US housing starts rose 6.3% month on month, and that is a rise from 2.1% in May and well above expectations, which were only 0.8%. However, building permits were poor. They fell 5.1% month on month compared to minus 2.9% in May, and expectations were for a rise of 0.5%. So that is not very encouraging for future housing starts. Existing home sales in the US were also strong. There were 5.86 million in June, up from May and slightly ahead of expectations. In the UK, public borrowing once again was worse than expectation. It's 22.8 billion in June, and that's up from May and slightly above expectations. In China, fixed asset investment for June came in at 12.6% year on year, which is down from May and slightly down from expectations, but still, frankly, very strong. Industrial production was 8.3%, which is reassuring. It was down from May, but above expectations. If we look at some charts now, This is the EU inflation rate, which has massively picked up, and it's been a downtick this month, and we'll have to wait and see whether it persists or falls back again. But the core inflation rate is much more subdued. So the high recent inflation is in part caused by transitory factors, as we have covered in many issues of the weekly. This is US housing starts, and that looks a very reassuring chart. That looks like a steadied rise since the lows of the financial crisis, essentially. But the picture painted by building permits is less reassuring. Now, I think the UK borrowing numbers are interesting because you would expect, as all the extraordinary stimulus measures come off, that UK public borrowing would return towards its historic norms, but it's not. It is still very high. So fiscal stimulus remains incredibly strong. And as we'll see in other charts, the same is true in the US. So you're still getting a lot of government stimulus. Now, in the US, we had a surprising and unexpected tick up in initial jobless claims for unemployment. However, looking into the numbers, it appears that most of those were concentrated in states where they had brought forward the end of COVID unemployment payments. So people were now off unemployment payment measures, and they've gone onto the dole, essentially. But if we look at continuing claims, then those continue to fall. So the US employment market is healing. Okay, on to other charts. Now, I thought this was a very interesting overview of where we are from Macro Strategy Partners. And it breaks down the cycle into various investment themes. And my whole portfolio is based on the fact that I think we should be in zone one, a reflationary boom, as the global economy opens up again. So I've got miners, commodities, haven't got emerging market stocks, but I would also, although I'm not short treasuries, I think treasuries should fall as inflation picks up. And I've been almost entirely wrong, because the market seems to think that we're in a disinflationary boom. So you'll see over the last few months that treasuries have been strong, and tech stocks and long-dated equities have all picked up.
Well, Keith, can I just chip in here? I think the market is actually slightly schizophrenic, because commodities have been very strong.
Yes.
Some miners have been strong, others haven't. And obviously tech, as you say, tech, pharma and biotech have been strong, but pharma and biotech have been strong for peculiar or idiosyncratic reason of COVID and the vaccination. So I think the market is actually slightly schizophrenic.
Yeah, anyway, they certainly don't believe in the reflationary boom, though. I mean, if you look at the behavior of US treasuries, I mean, they're really extraordinary, considering the uptick in inflation we've had. I mean, I think when we look back on this in 5-10 years' time, the gap between the change in inflation and the change in treasury yields is extraordinary, and I don't understand it at all.
Well, people are considering that inflation is temporary, aren't they? And therefore, once it drops, yields will fall as well. And
yes, absolutely.
That's the logic of the movement.
The market seems incredibly confident that the the inflation will be transitory. Okay, now last week we did a deep dive into inflation, and we got a bit of pushback for talking about inflation too much. And briefly, I just wanted to reiterate why we think inflation is so important. Because if inflation picks up, then your whole asset allocation has to change. And this chart, which we featured a few months ago, shows the PE ratio of US stocks under different inflation regimes. So on the x-axis is CPI inflation, and on the y-axis is the PE ratio. And you see, if inflation goes above 6%, the PE ratio falls rapidly. And so high inflation is really bad for stocks. And we have covered it before, and I won't go into it again, but there are very good reasons for that to be the case.
But I also think it's worth adding at this point, Keith, that probably no one, certainly not you and I, and probably none of our listeners, viewers, have actually invested in a high inflationary environment. So the last high inflationary environment we had was in the 1970s. Well, you and I weren't investing then. And I think unless you were investing then, you don't understand, you can't understand how difficult it is to make money and how easy it is to see your net worth, your real net worth, significantly impacted by high rates of inflation. And it's very important that if we do have high inflation, you understand what to do with your investments.
Yes. Very good point, Richard. Very few investors who are active in the 70s are still active. And so for the rest of us, it's going to be, if we do get high inflation, it will be a new experience. Yeah. And this chart basically reiterates the same point. On the x-axis is inflation, and on the y-axis is the forward 12-year return of the S&P. And as you'll see, as inflation rises and towards 10% and beyond, the forward return of the S&P massively drops off. Bear in mind, this is a big scale. You're talking about returns of -60 and above when inflation is going towards 10%.
And that, of course, is the real return. And you may feel you're doing well and you're getting an 8% return, but if inflation is 12%, you're doing badly.
Good point. And in the US, this is the Market Watch inflation pressure gauge, and inflation is rising. So, that is why we're covering it. We fear that inflation is rising and the market is very complacent about it. And this is a chart from Nordea, and this is a chart from earlier in the year, where they were looking at the inflation components, and they were saying that in Q1, commodity and food rises would cause US inflation to rise, and that's exactly what we saw. Then in May, June, temporary factors would start to fade and inflation would peak. And then in July and August, which is where we are now, that fading would see inflation numbers come down and the market would become complacent about inflation. But then in Q3, the rent inflation would start to come through, leading to strong inflation numbers and yet more temporary inflation pickups. And those, so lots of components of the CPI numbers coming in printing hot and adding up to a series of transitory inflation effects, which add up to persistent inflation. And here we have rental inflation, which they are forecasting to rise strongly throughout the rest of the year and into 2022. And in the US, a third of CPI is rent. And if the rent numbers start to come through at 10 to 15%, you're going to see a strong rise in CPI. Yeah. And when does the market then start to become concerned about persistent inflation? Okay, so this is a heat map of CPI. Richard, do you want to talk through this?
Yes, thank you, Keith. So you have to understand how these numbers have been put together. So a dark blue means there's very low potential for inflation, and a dark red means there's high potential for inflation. So, but what it's looking at is looking at a rate of change of the numbers, not the absolute number. So, for example, if you look at education and communication, well, in the last 3 months, that component has dropped. The price of that component has dropped, but nevertheless, it's significantly inflationary, because if you look over the previous 9 or 10 months, those numbers were significantly more negative. So the movement is actually a positive movement. And there's also another good example of this with airline fares, for example, where you go minus 27, minus 23 over on the right-hand column, and then suddenly you move to plus 24.6. So you get a massive movement in 3 months. So you get a very strongly red figure. So what this is showing is over the last 3 months, most of the components, all but three actually, have turned red to some degree or another.
So you're seeing a broad picture of rising inflation, essentially.
Yes.
And it's against this backdrop of generally rising inflation components that the Fed has got incredibly easy monetary policy. And this just reminds me of Nero fiddling while Rome burns, or actually Arthur Burns in the 1970s talking about how the massive inflation of that era was caused by lots of transitory factors. And the reason we have the core CPI numbers as opposed to just CPI was that Burns took out energy and food because he thought those, the high numbers, inflation numbers caused by oil or food were just transitory, and we needed to get core. And then he started taking everything else out.
So Keith, I would say a couple of things. First of all, the purchasing power of the US dollar has dropped by 97% since the US went off the gold standard. And the second point I'd like to make is that you can manipulate, not you personally, but one can manipulate CPI and core CPI till the cows come home. But the fact is, what's really happening is it's affecting the purchasing power of the population, of the electorate. And I think it's very wrong for people in central banks to suggest that inflation is unimportant, or we're going to go for average targeting and so forth, because effectively you're making people who struggle to make ends meet struggle even more whilst being in receipt of a public sector salary yourself. And I think there's something morally wrong about the approach to inflation by central banks.
Yes, well, I dislike a pint of beer at £7.15, I have to say, Richard.
It is, isn't it, Keith?
Okay.
Have you not tried home brew?
Sadly, my dad did, and that's put me off for life. But anyway, pushing back on what we've just said, this is a chart that shows the response of US consumers to rising prices for durable goods. And they're all saying that it is not a good time to be buying durable goods. And that could mean one of two things. If they actually delay or stop purchases of durable goods, that is very bad. And that would mean actually a slowdown from now. Or it could mean they go to their boss and demand a higher wage, in which case you get persistent inflation. Now, the other thing I'd say is that central banks and governments have one policy, and that is reflation. And so if you were to get a slowdown, you would see more QE, more stimulus.
Yeah. Also, I think one of the central bank arguments for why wage inflation is going to be harder than it was in the 1970s is there's much less organized labor, much less unionization, which is true. But I think that the capacity for people to organize themselves informally is actually far greater than it was in the 1970s. We have the internet and so forth. And the assumption that because there's less organized labor, wage inflation is unlikely to occur, I think is a dangerous assumption to make, because if proven wrong, it will have a huge impact on inflation.
Well, the other thing I'd say, Richard, is that what's really important is the quits rate. Because ultimately, if you're not getting the wage you want, you can quit if you think the jobs market is strong enough. And as we have seen, the quits rate has been rising strongly.
Yeah.
So in order to get employees, employers are going to have to bid up. Richard.
Thank you, Keith. So these are the charts of the small businesses open and following one of the small businesses revenue in the United States. And the interesting and rather alarming thing about these number of small businesses open is that not only is it on a downtrend, and has it been on a continuous downtrend since really a year ago, but it's actually now lower than it was at the nadir of the COVID closing. So 47.8% fewer small businesses open now than before COVID. And this talks of some sort of discontinuity in the understanding of what's going in the US economy. And I don't think we don't understand what's going on, but we think it is an important factor to note in terms of the recovery in the US, and presumably, I would guess, in the United Kingdom and in Europe as well. So the small business revenues are not quite as bad as the businesses open, which is obviously a good sign, but nevertheless, the current trend is downwards, not upwards, which is, I think, quite alarming.
Well, it paints a picture of COVID having done very serious damage to small businesses.
Yeah.
Now, that means that actually there's quite a large economic space to be filled if new businesses can grow into, if they can get the capital. So there are two ways to look at that. There's a lot of damage, but if we can get a self-sustaining recovery, it could be strong. Yeah. But it's early days.
It's very early days, and I think the jury has to be out in terms of understanding the damage that COVID has done to the world's economy. It has to be out for some time to come yet.
Yeah. Now, this I thought was a very interesting chart, and it gives an overview of holders of the US Treasury market. Now, if we go back to the financial crisis of 2009, you remember that Ben Bernanke, one of his explanations for what was going on and what had caused the credit crisis was a global savings glut, and the fact that the overseas savers had been relentlessly buying US treasuries, which had driven down the cost of borrowing in the US, leading to a credit bubble. You see that in the mauve line, which just rises relentlessly between 1990 and 2010. But that global savings glut has now ended. Essentially, overseas holders have not been buying treasuries, or they've been net sellers. And so the Fed has had to step in, and you'll see that on this chart how it has now become the second largest holder of treasuries. And that matters going forwards, because the Biden administration will continue to run an extraordinarily large fiscal deficit by historic standards over the course of his administration, if we believe the forecasts. And in order to fund that, the Fed is going to have to keep on printing. Now, if you don't believe inflation will pick up, you have to believe that the velocity of money will continue to collapse, and that money will not be spent into the real economy. Those seem heroic assumptions to me. Now, moving on to the US tech sector, which now has a price to sales ratio that's greater than in the dot-com boom. And, for those of us who lived through the dot-com boom, the aftermath was rather frightening, and the crash can come remarkably quickly. So tech valuations are higher than the dot-com boom, Richard?
Well, this is showing that the market is disconnected from the economy, Keith. So it's the cumulative S&P growth from 2007, so from the GFC, 200%. The cumulative real GDP growth is a mere 23%, and that's if you believe the inflation numbers in parenthesis. And the cumulative S&P sales growth, which is what profitability is sort of based off roughly, is 50%. So there is a huge disconnect. I'll just go back to the previous chart showing the selected ownership of treasury markets. So the whole point of QE, I'm now starting to believe, is to reduce supply of treasuries, so that increases the price and reduces the interest rate. If you reduce the interest rate, then that's the discount rate that you use for valuing other assets. So the discount rate you use for valuing the stock market drops, which means the stock market becomes more highly valued, which means that the growth rate in the stock market is much greater than in the economy. And of course, that then feeds through to a wealth effect. The wealth effect substituting from what one would consider to be real economic activity and real economic prosperity, which is the growth in GDP, which is a measly 23% over 14 years. So I think effectively what QE is doing is it's substituting for real GDP growth. But of course, it's a very dangerous way of substituting for real GDP growth, because it's like an inverted pyramid, and it's built on market confidence in the ability of the US government, in this case, to repay its debt.
Yeah. And also it means that low interest rates mean that we are building vast quantities of private sector debt in addition to public sector debt.
Yes.
Okay, so that's the NASDAQ, which continues to hit new highs. But we had a wobble this week in equity markets that was remarkably brief, actually, because the FTSE All-Share and the S&P have recovered most of their losses. But one thing it has done is shaken confidence. So nobody's bullish anymore. Okay, now finally, what I wanted to do with the charts this week was go through an overview of where we are at the end of H1. And these are all charts from John Kemp at Reuters. So this is world trade, and world trade is recovering nicely. That's a nice looking chart. This is US imports, and they're at an all-time high. They may be down this month, may be down slightly from last month, but that's still a very good looking long-term trend. Global industrial production is at an all-time high, and recent growth may have slowed, but still that's a good looking chart. US manufacturing is also recovering. The US PMIs are also strong. Again, you see this pattern where the last few months numbers perhaps aren't showing continued growth, but the general pattern is of strength. The ratio of inventories to sales in the US is very low by historic standards. That means that sellers are short of inventories, so manufacturers are going to have to work hard to rebuild stocks. That's all good news. New orders for durable goods are strong. That's great. Again, because inventories are low. Factories are having to work hard, and they're investing in new capital. In China, PMIs are not great, but actually they're higher than they were in 2019, prior to the COVID recession. Now, the chart we will cover next week is Chinese credit yields, which are rising and are a cause for concern. They're tightening credit conditions in China, which is a worry. In Europe, Eurozone PMIs are absolutely brilliant. They're the best they have been in the last 15 years. And that is outside Germany. German PMIs are okay, but the periphery, because there's been a great deal of stimulus, they're doing good. Commodity prices look very strong. Input prices in the US are rising. Now, everyone is assuming that inflation is going to be transitory, but that assumes that US manufacturers are going to absorb inflation, input price inflation. And it's early days, but I'm deeply skeptical. I think at some stage they will pass that on. And the bond market is saying that the chances of a recession are very low. Despite all that good news, Goldman Sachs are forecasting that GDP growth will now decline steadily until by Q4 next year, it's down to 1.5%.
Yeah.
And the background is continued massive fiscal stimulus from the US. So these are forecast US budget deficits plus Treasury net lending. And you'll see the Green New Deal plus fiscal stimulus and actually a very high structural stimulus now will lead to really high deficits by historic standards. You're talking, these forecasts are above 8% per annum. So the world economy is doing well. You're still getting massive fiscal stimulus. Monetary stimulus, this is, we saw last week, this is how far below the Taylor rule US federal policy is. It's like 5% below the Taylor rule. So it's massively stimulatory. And
sorry, Keith.
Sorry, actually, this chart shows it's the easiest it's been in 50 years. Richard, you'll go.
Okay, so I was just going to comment on the results of Unilever that came out recently, where the chief executive basically he said that for their input prices, the price of palm oil used in many personal care products was up 70% from the first half of last year.
Wow.
Soybean oil now costs 80% more, crude oil 60% more, and ocean freight 40 to 50% more. And it's hard to avoid price increases across the portfolio when it's such a broad-based range of commodity price increases, quote.
Yeah.
So this sort of concept of it being transitory is, I suspect, illusory.
Yeah. Well, the thing is, Richard, really what happens next? Because you're going to get goods inflation. The question is, does that lead through to wage inflation? Now, one thing we have not covered so far, but was in the news this week, is how NHS workers, and bear in mind the NHS is the largest employer in the world, have now got an offer of a pay rise of 3%. You can see wage inflation rising, and then with wage inflation rising, inflation becomes embedded.
Yes. And interest rates, traditionally, interest rates have to go up to stop that from happening. But how can interest rates go up when there's so much debt in the world?
Yeah. So, absolutely. But in conclusions about the state of the world economy right now, actually, all the numbers look pretty good. And the market is assuming that everything has peaked. But I think it's too early to make strong conclusions about that, particularly when we have very strong fiscal and monetary stimulus, and the world economy is still suffering from COVID restrictions.
Yeah.
So wait and see. Now, everyone's assuming that the inflation impulse is going to be transitory. What happens if they're wrong? Okay, moving on to the checklist. Well, equity markets, and These numbers disguise an incredibly volatile week in the market where on Monday, the oil share had a terrible day, down over 2.5%. But over the course of the week, it's largely recovered. It's down 0.3%. The Stocks Europe 600 is down 0.2%. The S&P is actually up on the week, up 0.2%. NASDAQ up 1%. The Japanese Topix down 1.4%. Bitcoin up 2.3%. And sterling continues to drift off, down 0.4%.
So Bitcoin continues to bump along this head and shoulders line. It started to look a little bit less like a head and shoulders at the moment, but I think time will tell. It's certainly in the doldrums at the moment. Ether is doing the same thing, but in a more animated fashion, and it's actually got above its 20-day moving average just now. It's had a little bit of a bump this week. The log chart of Ether, which I've also included this week, which is over a longer period of time, over 5 years. This one is. You can see it if you interpolate the straight line. You can see that it is going through the bottom of the candles. It's above that straight line still, and but on the other hand, it is putting in a sort of consolidation that it has done in many number of occasions before. I think now is not the time to enter into a trade in either Ether or Bitcoin. Now is still the time to watch what's happening, and this is a speculative trade as well. And you can see Keith smiling there. This is not an investment. And the last chart on this, Keith, is the altcoin chart, which had a mild uptick from last week, but is still showing very significant drop, over 50% drop from its all-time high back in April.
Yes. Okay, on to industrial commodities, and by and large, they were completely indifferent to the shenanigans going on in the equity markets. So aluminium was down 1.8%, but it's still very strong. Cobalt was essentially flat, down 0.1%. Copper continued strong, up 0.4%. Chromium was flat at its recent highs. Now, iron ore came off its massive highs, and we'll see the chart in a second, but it was down 5.6% on the week, but is still at very, very elevated levels. Neodymium is the big performer of the week, up 12%. Nickel continued its recent run, up 0.9%. Vanadium bounced, up 1.3% on the week. Now, crude had an absolutely extraordinary week, and we will see this in the charts. So crude fell massively earlier in the week and then has recovered all its ground. You really have to see the chart to understand what happened in crude during the week. So coal continued to rise, up 0.8%, and uranium was flat.
So Keith, can I just chip in there and say that although effectively the commodities didn't really move very much on the week, the commodity shares had a poor week, which contributed substantially to the poor performance of my portfolio. So there's currently a little bit of a disconnect between the commodity prices and the prices of the extractive companies, and whether that's just because the share prices got a little bit over themselves or people got a bit nervous because there was some movement in commodity prices, I'm not sure. But certainly a portfolio of commodity shares has performed significantly worse than a portfolio of commodities would have.
Yes, that's something we've covered many times in recent weeks on this podcast, Richard, and my own portfolio did incredibly badly again this week. Now, one thing that one of our regular viewers, Herman from the US, has brought to my attention is the close link between the oil price and oil equities and US treasuries. And this is rather extraordinary. This is the chart of the oil price against US treasury yields over the past few weeks. And you'll see they're very tightly linked. So essentially oil is trading like a reflation asset as opposed to a commodity?
Now, I think that makes sense because if you assume that the supply of oil is fixed, which it isn't, but if you assume that it is, then the price of oil is highly sensitive to people's views of how the economy is going to grow or otherwise over the course of the next weeks and months. So I think that makes sense. I think that there was a nervousness that the Delta variant was going to throw all economies off the rails. I don't think that's going to happen in vaccinated countries.
Yeah.
There's an assumption that the supply of oil is fixed, which it isn't. But we know that OPEC has been having discussions about how it's going to manage the ongoing supply of oil.
You see, I'm going to push back on that, Richard, because I think what it's saying is that oil is trading like a financial asset, like US Treasuries, rather than as a commodity driven by its underlying fundamentals.
But why would it trade like a financial asset?
Well, this is why, because essentially investors are investing in the reflation trade. We know during this period that the oil fundamentals are underlying strong, but there have been some news from OPEC and also from the US inventories, which this week were disappointing. But actually, none of that matters. What matters is the movement in US Treasuries. So it's behaving like a financial asset.
Possibly so, Keith. We'll see. It's a very short-term chart.
That is true. But then Herman went on to say that there is seasonality in the US Treasury market and that yields tend to hit a low in August, July and August, and then rise for the course of the year. So in which case, oil may have bottomed, he says. Anyway, moving on to some charts. So aluminium is remains strong. That's a very good looking chart. Seems to have hit a plateau, but no sign of falling. Cobalt, having fallen back, has recovered everything to return to its previous highs. Copper is having come off its highs, has now reached stable state, looking strong. Crude oil, this week's shenanigans don't. Oh, sorry, this is crude this week, actually. It's just 5 days.
Yeah. And
so you'll see we had an absolutely extraordinary fall. It fell from $72 to 66. So about 8% fall. And then in 3 days, it's made it all back. Sadly, oil stocks have not made it all the way back, as we will see when we go through my portfolio. Coal, last couple of days have not been so good, but what an extraordinary looking chart.
Yeah.
Very strong. Richard.
Thanks, Keith. This is a graph of projected coal demand. And basically what it's saying is that despite all the best efforts of governments to green the economy, the demand for coal, this mostly thermal coal, isn't going anywhere for quite a few years yet. But supply, I suspect, is likely to become more constrained as governments say that coal mining is a bad thing to be doing for the environment. So I think there's probably strong upward pressure remaining on the price of coal.
Well, if the supply of coal is constrained by government and the price goes through the roof, then that's good news because it will increase the speed of the energy transition as everyone switches into cheaper renewables.
I was reading an interesting article about China. The problem China has is that a lot of its power generation is coal, and the price of coal renders those generators unprofitable at the current price of the electricity they're producing, which is state mandated. So a lot of Chinese energy producers are moving into financial difficulties as a consequence of the disconnect between the price of coal and the price they can sell their power for.
Very interesting. Thank you, Richard.
So this one is a fascinating chart of everybody's projections about how renewable energy is going to take over from fossil fuel energy, and it goes back to the 1970s. Basically, if you look at number one, physicist Bent Sorensen had his trajectory basically saying 50% of energy would be renewable by the year 2000, and so it goes. And the most recent projection by Google 2030 Clean Energy Plan is way off. And basically what it's saying is predictions of how much energy will be generated via clean energy have so far been very far out and hugely over-optimistic. It's a very difficult problem to solve, I think, is the answer.
It is. As we've seen in previous weeks, solar plus wind is currently only 3% of the global energy mix. We've got a long way to go.
Yeah.
So iron ore came off a bit. It's still, when you look at this chart, it's still an amazing chart. Over the course of the last year, the iron ore price has doubled. Neodymium having come off, this really looks like the cobalt chart, actually. So, you get this speculative high, comes off, flushes all the speculators out, but there's strong underlying demand, and it's going back up again. Nickel, again, strong, despite the supply glut. Ferrovanadium, having had a little sell-off, is now resuming its climb. Now, this is the lumber chart, and it just is a warning about getting carried away in commodities, because the lumber price essentially fell by over 2/3 in under 3 months. Now, lumber is very small in a liquid market, and as Richard pointed out in previous weeks, during some of those falls, you couldn't get out because it was limit down every day. So be warned, commodities can be dangerous. Okay, moving on to precious metals, and during the shenanigans in the equity markets, when you would expect investors to rush to safe havens, gold and silver did badly. So gold fell 0.9% on the week. Silver had a terrible week, down 3.2%. Platinum down 3.7%. Rhodium resumed its falls, down 5.1%. Palladium was flat. So this is gold price, not going anywhere fast. Silver kind of flat over essentially the last 8-9 months. Platinum, again, subdued. Rhodium at least seems to be forming a bottom, we hope. Palladium recovering a bit. Okay, moving on to base rates. Well, base rates in the UK and the US remain flat. The tale of the week essentially is a massive decline in yields. Investors rush to safe havens in an absolutely extraordinary fashion. So investors are giving up on the reflation trade. They're increasingly sure that the inflationary impulse we're seeing is transitory, and they are rushing and buying UK 30 years at a yield of 1.016% this week, which is down by 12 basis points, 13 basis points on last week. So if you think about this, there's been a 10% drop in the yield of the 30-year over the course of the last week. It's absolutely extraordinary. And they're willing to accept negative yields on UK 30 years.
Negative real yields.
Yeah, negative real yields. Now, this is a chart sent to us by a friend of the podcast, Stuart Owen, which shows how many years of coupon loss you would suffer if there was a 1% uplift in yield. And obviously, as yields head towards zero, the number of years of coupon loss you would suffer from a 1% uplift in yield massively increases. And so now, this is the danger of holding bonds. If yields start to rise, you suffer massively.
Yeah.
So this is the UK 30-year. I mean, look at this. The yield now is back where it was in November last year, despite the economy opening up again and massive stimulus.
And massive debt increases.
Yep. US Treasuries back where they were in February. And seasonality chart, well, we're in the summer doldrums, basically. Richard, your activity.
So I had a poor week, Keith. I've now 7 poor weeks in a row, rather depressingly. I'm quite invested in commodity shares, as people know. So it's down 1.9% on the week, year to date. Now 3.9%, which is not very good. I made a purchase during the week of a company called Graphene Manufacturing Group. Now, as we all know, graphene shares are widow makers. So I thought that I should have a bit of a flutter on this one. So why did I do it? It's a very good question. So it's quoted on the Canadian market. It has a market cap of $116 million. And this is a share price graph. And I bought it when the graph was looking like it wasn't very good, and there was no indication that it was going to move upwards. But nevertheless, I broke all my own rules and I bought it at that point, and it has dropped about 20% since I bought it. So not good timing at all. What does it do? So basically, it's an Australian company. It makes graphene. It has a technique of making graphene from natural gas. It supplies graphene coatings and lubricants, but my particular interest in it is developing a rechargeable graphene aluminium ion battery. And it's doing this in conjunction with the University of Queensland and with Australian government funding. And it has potentially much better charging characteristics and greater power densities than lithium-ion batteries. No fire hazard because it has no volatile organic solvent in it. And it is initiating production of those little flat coin-shaped batteries. And if graphene aluminium ion batteries are a battery of the future, then I thought this was a way to get into it. So I'm going to hold this one for a period of time. That's my cunning plan. And I would just say that personally, I find the concept of driving around with a stonking great lithium-ion battery in your car, which is liable to explode and burn your car, and possibly you in it, which can't be recycled and which is hugely energy inefficient to make. I don't like this. I don't like the feel of that, and it feels to me like it's a technology that is going to be replaced. And it's going to be replaced with something much more subtle and sophisticated. And maybe the graphene aluminium ion battery is such a thing. Maybe it's not. Anyway, my advice is not to buy it now, but just wait to watch the share price continue to fall and buy it when you feel it has bottomed. And you can have a good laugh at me for buying it much too soon. So the other thing I wanted to say, sorry, Keith.
Well, what I'd say is this is really interesting, Richard. And I'm very impressed of actually going into production with these batteries, because that is genuine progress. And my concern about graphene is that it always seems to be, 5 years in the future.
Yeah, I think that's a fair comment, Keith. I think about graphene is such a clever material, has such wonderful properties that at some point it will become a highly utilizable product. But it's not there yet, and it's very difficult to try and time this market. But I thought, as you say, they have a specific product going into use, which is a battery, which will go in things like clocks and watches and hearing aids, and it's rechargeable. So, but what I wanted to say is there was some chatter on our Discord, and one of our regular contributors to Discord made a comment about wanting to average into a share that had dropped by 20% from when they bought it. And I put a comment on the Discord channel, but basically my view on averaging down is it's probably best not to do it. And the reason I say that is that it's likely that the reason the shares are dropping is because someone knows something that you don't know. And my view is it's much better to wait for good news to come out and then buy the shares rather than buy on the basis of what is probably bad news because the price is dropping. Now, it's very tempting to believe your story that the particular company is going to do well because, but you always have to bear in mind you do not have perfect information. There is information out there that may be significantly impacting the price that you're simply unaware of. And so I am increasingly adhering to the point that don't average down and only buy on good news. And I suppose my excuse for Graphene Manufacturing Group is that the initiation of battery production is good news, although the share price hasn't reflected it yet. Keith, would you like to tell us about your week?
Thank you, Richard. Actually, before I get going, just to come back on your point about buying stocks as they go down, averaging down, I agree with you. The only caveat I would say is if you're buying a stock which is a cyclical stock and you are trying to time the cycle, you never get the cycle right. And so if you believe that you are trying to get the bottom, then that makes sense. But if you're buying a secular story, so development, whatever, then don't average down. And actually, in general, I think your point is probably a very good one, that if you want to avoid stress, don't average down, because it just increases your liability, basically. And it's something that I'm going to have to improve on. And, investing is a learning process.
And I think also, just as a final point, Keith, before you set off on this, that if you think the company is a good news company, it's going to do well, wait for the good news, and buy on the good news, even if you're buying at a higher price than your original entry point.
Yes, no, that's a really good point, actually, because I noticed that, was it Sahil on our Discord was saying that he never buys above the price he's got in at. And you have to get away from that. You have to steel yourself. It's uncomfortable, but actually buy on a rising trend. And historically, I've been very much in that camp. I don't like buying stocks in the new high, but actually, I increasingly think that's what you've got to do.
Yeah.
Okay, so I had a terrible week. Actually, these numbers slightly disguise how bad my week was. So I was hiking in the Brecon Beacons, and the first time I checked my P&L was on Wednesday morning, and I was then down 5.2%. So I've now recovered to be down 1.7% on the week, which puts me up 0.27% on the year, which is frankly terrible. So I'm underperforming Richard, Stewart, the FTSE All Share by a massive 9.1%, which is frankly embarrassing. And my portfolio is 100% aligned to the reflation trade, but I've thought about it and I'm sticking with it. So during the week, there was a placing in Enquest. We're seeing a lot of these small oil companies trying to rebuild their balance sheets. So I had to put some capital into that. I then added to two of the companies which I like, which I think are doing well. So now Capital Drilling, we talked about last week. And as the shares came off this week, I bought some.
And they had published good news recently, hadn't they, Keith?
They had, and I think the shares remain undervalued, and they're one of my few winners. So adding to winners at a new high. I'm getting better at this game, Richard, I think.
Let's hope so, Keith. Fingers crossed.
Though there seems to be no evidence for that. So, and I also bought some ferroalloy resources, which has ticked up. And I am very bullish on that long term. But this is the story of my portfolio, and this is BP. So this is the blue line is BP, the green line is crude. And you'll see over the course of the last 2 weeks, crude is up 2.5%, BP's down 5.7%. So just generally very disappointing for oil equities, which you have seen that treasuries have been very strong and oil equities seem to be the reverse. When people rush into the safety of treasuries, they seem to be selling reflation trade assets like oil companies. And I'm betting at some stage that reverses as the world economy opens up and we get a normal recovery. But so right now, I'm not having a very good time, frankly. I have drawn down, 8 or 9% in the last few weeks, but this is the performance of my SIP since I started managing it in 2011. And over that time, I believe the FTSE All Share has done absolutely bugger all, actually. But I'm up over 200%. So,
well, you're good.
Yeah, you can't win them all. Yeah, it's volatile. As you'll see from this chart, I've had some periods of poor performance, but you stick with it and hopefully it comes good.
Yeah, you stick to your principles.
Yeah. So on that note, if any sponsors would like to get in touch, remember we have principles. So weapons of mass destruction are perfectly acceptable. Dodgy financial products, no. So on that note, thank you all for watching. Please can you press subscribe and like, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.